Okay, guys, so welcome to tonight's class. So this is class 5 of 8 classes. And so what we're going to do tonight, we're going to do working capital. So I was going to do capital budgeting, but there's no real capital budgeting question within the assignment. So I'm first going to work through the assignment, and then we're going to do a capital budgeting. I'm going to choose a question from a past exam paper. Okay, so so what we'll do in the last week, so next week we will do, so tonight we're going to do working capital. Tomorrow we'll do financial analysis because there's financial analysis in the assignment. The next week in the last 2 sessions, we will do valuations and capital budgeting. So valuation question I'll take from a past exam paper as well as capital budgeting. So if you can go to question 2 in the scenario, I'm going to hop over there now, and then I'm going to read through the scenario. As I read through the scenario, then I'll give you a high-level overview. Actually, what I'll do first, I'll first give you the high-level overview, and then we will go over to the scenario and answer that particular question. So the question is, what is capital budget? I mean, what is working capital? What is the purpose of working capital? And what can they test you? What you need to be able to calculate? So remember, with working capital, for many companies, without working capital, they will not be able to operate. So for example, if you take Pick n Pay and ShopRite, without the groceries in the store, they won't be able to make money. So inventory, which is part of your working capital, that plays a critical role in the company making money. Similarly, and then for Pick n Pay and ShopRite, how they obtain the inventory, the groceries, they buy it on credit. So generally, they would buy inventory, the groceries you see in the store, within 30 days, they sell it, and they only pay the suppliers after 60 or 90 days. So what you would notice, they will sell inventory 3 times before they make the first payment. Okay, so before they have to pay the suppliers for the first lot of inventory. So the working capital, to manage working capital is extremely, extremely important. Similarly, if we look at Truworths, Woolworths, Foschini, without them having clothing in the store, they won't be able to make sales, right? So therefore, their clothing, which is their inventory, plays a critical role. Foschini and Truworths, I'm not 100% certain regarding Woolworths, but like Foschini and Truworths, about 90%, 95% of their revenue is made on credit. So therefore, the credit sales plays a critical role in them making money. So credit sales sits in the balance called debtors. So that is why debtors and inventory, which is part of your working capital, plays a critical role in the operations of the business. Without having inventory, without having those credit sales, the Foschini and Truworths won't make any money. Similarly, for Pick n Pay and ShopRite, without the inventory in the store, without the groceries in the store, they won't be able to make any money. So therefore, inventory and debtors, which is your working capital, plays a critical role in running your operations and making money. So it's very important. The thing is with working capital, though, the return is quite low relative to what you can use and invest in something else. So therefore, the management of working capital is extremely important. So there's a fine balance between having enough and having too little working capital. Okay, so that is something that you'll focus on in the real world, where you'll have to manage that. So like Pick n Pay them, and especially like Truworths and Woolworths, they have teams that focus on the management of working capital. And then what goes with working capital is creditors, because most of the retailers, they buy on credit. And as a result, that plays a critical role because basically the inventory or the operational cycle is funded through creditors. So think of it like this. I'm going to use like Truworths or Foschini, they need, in order to make a sale, they need inventory, they need clothing. So basically they will obtain the clothing, which is the inventory. And once it's in the store, it does not get sold immediately. Let's say, I'm just making up numbers. So let's say it stays in the store for 30 days. So they obtain the inventory, they obtain the clothing, and it sits in the store for, let's say, 30 days. After 30 days, it gets sold. But when it gets sold, they don't receive any cash. All that happens is it's one asset gets transferred into another asset. Inventory gets transferred into debtors. And in debtors, it will sit there, let's say 60 days. So, you know, like with Fushini and so forth, you have like a store card that is either 6 months or 12 months. So you can understand how long it takes to receive the money. But I'm just making it simple to make it 60 days. So now you make the sale of inventory after 30 days. And then that sale sits in debtors for the next 60 days. So basically, your cash is tied up in inventory and then in debtors. So your cash is tied up for 90 days, 30 days in inventory, 60 days in debtors. However, over those 90 days, you still need to pay water, electricity, you still need to pay rent, you still need to pay your salaries and wages and all of those type of stuff, right? So there's still other cash flows that take place. So the company needs to ensure they have enough cash flow to pay all of those other stuff, and they need enough cash flow to fund the inventory that is basically only being converted into cash after 90 days. So how do they fund? The first source of funding is going to be the creditors. So what happens? When they buy inventory, they don't buy inventory immediately. Let's say the creditors fund them for, 30 days. So what does it mean? Inventory, clothing sits in inventory for 30 days. Then when it gets sold, it sits in debtors for 60 days. So the total operational cycle is going to be 90 days. But what happens is, so without creditors, they would need cash, they would need funding, they would need finance for 90 days. So how do they obtain finance? Basically through creditors. So if creditors give them a 30-day period, that means for the first 30 days, that operating cycle is funded through creditors, and that means they only need additional funding for the other 60 days. And how they obtain that funding, there's different ways. They've either obtained it with cash, with a cash in their bank account, but most companies don't want to use a cash in their bank account, but they can use cash in their bank account, or they can obtain, in most cases, they have an overdraft facility. So that's another way. Or they basically, if they really don't have money, they don't have cash in the bank, or they can't obtain, or their overdraft facility is not enough, then they will take out some loans, okay, whatever type of loans, short-term loans or something of that nature. So that is what is the importance of working capital, because if you can't, if you don't have enough cash, you won't be able to operate, because you wouldn't be able to pay your creditors, you wouldn't be able to then buy in inventory, you wouldn't then be able to buy, pay your suppliers, pay your staff, your water, electricity. I don't know if you some time ago, where, you know, like with the airline industry, I think it was like Mango or something, where they need to, they can't fly because either the BP who supplies, I think, SAA with jet fuel, don't want to give them jet fuel because they didn't pay their balance. So there you can see, because they're not they're unable to obtain fuel because they can't pay, they don't get fuel, so they can't fly. Or I think SAA as well, so remember, in order to operate over here in South Africa, you pay a license fee or some type of fee to ACSA, Airports Company South Africa. So when they couldn't pay whatever fees they needed to pay, then Airports Company South Africa bar them from flying, operating. So as you can see, that has a crucial impact on the business. So managing working capital is critical for the long-term success of the business. Although working capital is something short-term in nature, but that short-term in nature stacked over time, building the business, operating the business every single day will ultimately provide long-term success. And that is why managing your working capital is of high importance for companies that makes use of working capital. Okay, so that's important. So for our purposes, on a CTA level, there's a little bit more detail on it, but for our purposes, what do we need to be able to calculate? Number one, so in no particular order, but basically number one, you must be able to calculate the cash operating cycle. So that is basically inventory days plus debtor days minus creditors days. You must be able to forecast. You must be able to forecast working capital. So, for example, what they would do, they would tell you that working capital is a percentage of revenue. Just say, for example, let's say working capital debtors is 10% of revenue, inventory is 5% of revenue, and so forth, right? So then they'll tell you next year revenue is going to increase by 20%. So now you get a new revenue figure, and then using the details of the scenario, you must be able to forecast how much inventory you need, how much debtors you need, and how much creditors you need, because that will help you to know what funding you require. Okay, so that's the second one. The third one is basically and there's past two exam papers on this issue, and this is when it comes to debtors, it is like you can understand with Foschini and with Truworths, I think like 90 or 95% of their revenue is obtained through credit sales. Mr. Price is a bit different, because I think Mr. Price is purely cash, whereas Foschini, Truworths, and Woolworths as well, but I don't remember the percentage of Woolworths sales, but Foschini and Truworths is like 90, 95%. So it's quite high, or 80%, but it's quite high, the percentage of sales that is on credit. So the question comes around where they will tell you that a company wants to change their credit policy. So credit policy means just basically the rules of being able to open up an account with the company. So what they would do, they would say, this is the current credit policy, and this is the proposed credit policy. And they're going to ask you, do you think the company should go ahead with the new credit policy? And then you need to work out whether they should or whether they shouldn't from a quantitative point of view. So I will look for a question like that another time, and I'll show you. So perhaps in the revision class, I will go through a question like that. So it's very important that you're able to work through a question of that nature. And I'll show you, when you look at the solution, it might seem complex, but when I take you through it, I do it slightly different. We get to the same answer, but I do it in a different manner, and you will see that it's not as complex as if you look at the solution they generally provide, especially in the textbook that we use, that UNISA uses. It just seems very confusing. But once I take you through it and I explain to you what we're trying to achieve, you will see that it's not as complex as it seems. But basically, it's going to come down to the following, right? So when you have a credit policy, you basically have one of two choices. One, you can have a strict credit policy, or two, you can have a relaxed credit policy. So when you have a strict credit policy, it means it's difficult for anyone to obtain a store card with you. So only people with certain credentials will be able to obtain a store card with you. So that means less people can obtain a store card from you, which means you will make less sales. However, it does not mean that you're making less sales that is a bad thing. You have to go through the entire process. So yes, you're making less sales, but as a result of that, because you're having the quality of customers now is of a more higher quality, the amount of bad debts will be less. And because you're making less sales, the debtors balance on your balance sheet will also be less. So with having a smaller amount of debtors balance, it means you need less funding. So it means you're paying less interest. So you look at all of those type of things to get to a number. Whereas when you have a relaxed credit policy, that means more people can obtain a store card, which means more people can buy on credit. So the sales value will most likely be more than with a strict credit card, a strict credit policy. However, with more people being able to obtain the store card, it means the quality of customers would be a bit lower. And as a result, your bad debts will be higher. Together with that, you're going to need a higher debtors balance because more people is buying on credit. And as a result, you will need more funding for that debtors balance. So that means you're going to be paying more interest. So that's why you have a look at you must look at the entire process to actually see which one is more beneficial and which one is not. So there's not a right or wrong answer. It all depends on what you expect the number to be. Obviously, from an academic point of view, they will come out to be an answer, but in the real world, all of these stuff would be obviously judgmental, thumbs up. I don't know how they would get those information, but it's generally going to be thumbs up or maybe from past experience, and you would expect a certain outcome, but that doesn't mean it will actually happen. But from our purposes, there will be a right or a wrong answer based on the information and based on the analysis that we perform. Okay, so just be aware of that. Like I remember in the news not too long ago, when I say not too long, a few years back, so with I think the National Credit Act and some other act came out with limiting how who like Fushini and so forth can lend to, right? So there was strict criteria. So like the CEO either of Fushini or Truworths, like was saying, the problem with those criteria is that that means they can't issue more people a store card because the criteria is too strict. And if the criteria wasn't that strict, they would have issued to those people. And obviously the Act's intention is that they want to avoid companies allowing people to go into, to be too overly debted, right? But like that CEO was saying, they understand the objective of the Act, that they don't want people to be overly indebted, and that's why they're so strict. But they said the objective was not being achieved because the people couldn't now obtain store cards from Fushini and Truworths, which is more an accredited institution. People went like to the, like I say, backdoor market, you know, like where there's no regulation. So he said actually in the end, it was worse for the customer or the consumer because they can't get from all other financial institutions that is regulated, but they still need the money or the funding. So what do? They go into markets that are not regulated, and in the end, they're actually worse off. So that was their stance. Whether it changed or not, I don't know. But basically, obviously, he was saying in that way because for them, their revenue is always going to be impacted, given the fact that a large percentage of their sales are on credit. So working capital is very, very important. Okay, I remember when I was I think third year or in CTA, you know, went through one of the companies. I think it was I remember the company. It's on my head. I can't just now remember the name. It's quite a well-known company. What's the name now? It's on my head. I just can't remember. So the way they used the management of working capital to actually generate more cash flow. So they basically reduce the number of debtors, they reduce the number of inventory and all of those type of stuff. So they tightened up their working capital. so that they can have more cash flow available. So you will see in the real world, it does get used quite often, because in many cases, sometimes working capital is not managed that well. So if you just be a little bit more strict on it, your cash flows will be a bit better. But obviously, you can't manage working capital only forever and ever, because there will come a point where you have to stop reducing working capital, because otherwise you won't be able to operate. Okay, so just be aware of these type of stuff that is really relevant in the real world. Okay. So that is the key issues relating to working capital. It's all about debtors, inventory, and creditors. The main is debtors, because they ask you the credit policy. For inventory and creditors, not like a specific stuff. There is other things, but it's not like big marks. Okay, so debtors is the big one. So let's move. I'm going to switch now over into the assignment, and it's question 2 of the assignment. So you should be able to see my screen. So you can see question 2, 15 marks. So working capital generally going to be 15 to 20 marks. They're actually between 10 and 15 marks, but sometimes again pushed up to 20 marks. So it's a fairly long scenario for 15 marks, but let's read through it. So they say Paw Patrol is a company that operates in the safety and security industry with a specific focus on domestic security systems. They are retailers in security devices and appliances. The following information is available on 28 February 2021. Okay, so they're into security systems, okay, and appliances. So there we can see turnover, we can see note 1. We have cost of sales, and cost of sales is made up of those 3 items, and purchases is note number 2. Then we have operating expenses, which is note number 3. And you have all the other stuff, which gives you profit for the year. Then they split the profit between shareholders and NCI. Then they have the balance sheet, and we have non-current assets. You can see the stuff made up under non-current assets is a note number 1. And then we have current assets, which is made up of inventory, trade receivables, and cash. And then we have equity and liabilities. So there's various stuff over there. Okay, so let's read the different notes. So here we have notes and additional information. So they say note number 1, credit sales increase. So very important, credit sales increased from 55% of turnover in 2020 to 65% of turnover in 2021. So that's very important when you're working with working capital, to identify where the sales, you can split sales between cash and credit. Okay, so it's important to take note. So in 2021, 40% of the company's purchases were made on credit in comparison to 50% in 2020. Okay, so take note of that as well. Operating expenses includes a once-off expense related to expert valuation costs incurred during the year in order to write down the value of goodwill. Credit terms for the trade receivables of a company are 60 days from invoice date, and for the standard industry term, it's between 45 and 60 days. So there you can see we are 60 days, but the industry is between 45 and 60. So we're on the far end. So we'll have to have a look if there's a better way to perhaps maybe reduce the number of days or something of that nature. They say the company payment terms to trade payables are between 45 and 60 from invoice date, and discount of 10% is received if payment is made before 45 days. Standard payment terms for the industry are 60 days from invoice date. Okay, so it looks like we're within the bracket. So ideally, we don't want, you'd want to max out the number of days. So ideally, you'd want to pay not after 45 days, you want to pay after 60 days. Okay, the only thing that company would have to assess is whether they would be better off to make use of this 10% discount or not. So there's a formula for it. I never remember the formula, but I'll show you the formula once I look at the textbook. Okay, so the average inventory turnover period for the industry is 90 days, and the average business cycle for the industry is 100 days. Okay, so they're not telling us what is our inventory days, but they're telling us what is the inventory days for the business, for the industry, as well as the business cycle for the industry. So we're gonna have to work out inventory days, and we're also gonna have to work out what is our business cycle. So you can already see, so then if our business cycle is more than the industry, then, because remember, if you want to make comparison, there's different ways to compare. You either compare to an industry, or you compare to your last year financials, or you compare to your budget, your target. Okay, so in this case, it appears that they want us to compare to the industry, because they're always mentioning the industry as a comparison. Okay, so just take note of that, because you wouldn't be able to comment or judge if you're not comparing to anything. So that is why it's very important when you look at this, that you need to compare. And so there's different ways to compare, like I made mention. Okay, so if let's say our business days are more 120, let's just say it's 120, but the industry is 100. So you can see we are, so this 100 days means it takes 100 days for a company to convert its inventory and debtors into cash. So if we're taking 120 days, it means we're taking longer to convert our assets into cash. So we then have to find ways to reduce it. So remember, how can you reduce it? You can reduce it either by reducing assets. So for example, reducing inventory days, reducing debtors days, as well as increasing creditors days. And I'll show you why that makes sense. So here you can, so let's say it is more, you can see for debtors, it's between 45 and 60. We allowing 60 days. So perhaps we should try to reduce it to 45. Same over here. We are between 45 and 60. Yet the industry is at 60. So perhaps we should push it up to 60. So that will help us with our cash flow. Or alternatively, we must have a look if taking a discount would be beneficial. Okay, so that is what we must look at. Okay, and then we can have a look what is, so we know the industry inventory days is 90. We would have to have a look what is our inventory days and see if we're more or less in line with the industry. They say all materials are purchased on a just-in-time basis. The inventory in the statement of financial position consists of finished goods only. Okay, VAT is levied at 15%, and the company's tax rate is 28%. You may also assume there are 365 days in a year. Okay, very important, take note. They'll sometimes say 360 days. So if I use 360, then you use 360. So now let's say calculate the business cycle of Paw Patrol Limited for the year 2021 in days, and comment on the performance of each subsection of the calculation included in line with the additional information. Use closing balances and round off your answers to 2 decimal places. So I'm going to ask you to do this for me. Okay, I'm going to set it up. I'm going to give you the formula, but I'm going to give you 15 minutes to do the actual calculation. So it's not hard, because I'm going to give you the formula, I'm going to give you the setup, and all you need to do is take the income statement and a balance sheet to actually perform the calculation. I just want to get quickly to, I just want to get open up, what you call it, Excel or Google Sheets. Okay, so let's have a look what's happening over here. Okay, so operating the business cycle or so the business cycle or the operating cycle. Okay, so the cash sorry, so it's business cycle. Another term called for it is cash conversion cycle. Okay, equals inventory days plus debtors days minus creditors days. Okay, so that's basically it. So I'm going to set it up over here. So we will have inventory days plus debtors days. So I'm just going to put another subsection over here. So just in case I ask you this in another question. So inventory days plus debtors days is known as the operating cycle. Okay. So inventory days plus debtors days is known as the operating cycle. Okay. So inventory plus debtors equals operating minus creditors days. And that will equal to your business cycle or your cash conversion cycle. So this is business cycle or cash conversion cycle. Okay, so you may just be aware of that. So the formula is as follows. Okay, so the formula is as follows for inventory days. It is this thing quickly. It is inventory divided by cost of sales. Yeah, divided by cost of sales times 365. Okay. Debtors days is debtors balance divided by credit sales. So not any sales, credit sales times 365. Okay, and then creditors days is creditors divided by credit purchases. Okay, times 365. Okay, so if I'm going to give you 15 minutes to answer this, and then I will calculate it with you afterwards, and then we will work through it together. Is that okay with you guys? Okay, so I'll give you till 7 o'clock to work through it. Okay, do you guys have the assignment with you? Just, can you just let me know you guys are okay to get going? Okay, so I'm gonna give you guys some time now. I'll be back by 7 and then we will go through it. So I'm gonna give you the 15 minutes to work through it. So to do the calculations. Okay, guys, you're done. You need some more time, or can we get going? Want to say something, Dave?
No, no, so I'm with you. I'm really when you are.
Okay. Okay, so let's get going. So to work out inventory days, we see this inventory divided by cost of sales. Okay, so inventory divided by cost of sales. So let's have a look. So there is inventory 2021 and cost of sales is 3850. Okay, so if I go back, it's going to be equal inventory 1.2 million, 123 divided by 3850, 123 multiplied by 365. Okay, so the number of days is 113. Okay, so just take note of that. So you can already see we're higher than that of the industry. The industry is 90 days. Okay, so so industry is 90, we are 113. Okay, I'm just going to do this for our purposes. So I'm just doing this for our purposes. You don't have to do the column I'm going to do now, but basically company and industry. Okay, this is the industry column just for our purposes. Remember the operating cycle line item is over here. It's not required. I just added it in because if they ask you for operating cycle, then you know up until what point you need to go. So remember the invent was 90 days. Okay. Then for debtors days, it is debtors divided by credit sales. So debtors is, so let's see if I've got that right here quickly. Okay, for 2021, okay, so that's fine. So debtors is 1048. So you must just be careful. Here they just say trade receivables, so it's fine. But sometimes they can say trade receivables, but there's different things included in trade receivables. The trade receivables we're interested in is only debtors. Okay, so because there's no additional information, we assume that is totally fine. So 1048. So it's equal to 1048,123 divided by, now we want credit sales. So remember credit sales was in the current year 65%. So we go to turnover. Turnover is sales. That's 8.5 million, but that's total sales. We only want credit sales, almost 8.5 million times 65%. Okay, so I'll say 8.5 million, 123 times 65%. So our close and our close divided by, multiplied by 365. So that is 68 days. So remember, our credit policy is 60 days, but we are currently at 68 days. So that is a bit of a problem. And remember, the industry max is 60 days. So we at least want to drop it down to 60, but preferably we want to do it better than that. Okay, so remember the industry. Okay, we have to make. We'll see now what was the industry. We'll just see again. We'll get back to that one now. So the operating cycle is the sum. Okay. Now we must do creditors days. What is creditors days? Creditors is creditors divided by credit purchases. So creditors, where's creditors? Creditors is trade payable, so 350. So we're going to say equal, open bracket, 350, 1, 2, 3, divided by, okay, credit purchases. So remember, credit purchases in the current year was 40%. Okay, so we go to purchases, and purchases is 4.2 million. That is total purchases. Of that, 40% is on credit. So I say 4.2 million, 1, 2, 3, times 40% times 365. Okay, so you can see the creditors is supposed to be between 45 and 60 days. We are at 76, so we are taking longer to pay, which is okay, right? So it's better to take as long as possible, as long as it does not impact your relationship. So remember, if you take long, it helps you with cash flow. But remember, if you take also long, you don't know what is the impact that it has on your relationship with the supplier. So the supplier may be okay, then it's fine. But if the supplier is not okay, it could lead to them you so can break down your relationship. So then they'll charge you interest on overdue accounts. You won't get preferential pricing and all of those type of stuff. So it's those things you need to consider. Now, these are real world stuff that you need to consider. So if they're not happy with the way you handle them, your relationship not great with them, you're not going to get preferential pricing. You're not going to get discounts, and they may charge you on overdue balances. But if there's no of that issue, if the relationship is still okay, then by the longer, the better. Okay, because remember that means you need less funding elsewhere. So therefore, our operating cycle is that minus, and the industry is 100. Okay, I just want to see quickly what was the other balances quickly. So inventory days was 90, that's what they said. The industry is between 45 and 60. Okay, so we can't really put an amount. And let me just see what they have for debtors. Standard payment terms for the industry are 60. Okay. So we say 60 over here. So this answer needs to be 160. Because remember, 160 minus 60 will give you 100. So that means on average, debtors is, what will give me 160? 70. Okay. That kind of seems what you call it. But basically, you can see that our inventory days is far larger than debtors days. So this is going to be the commentary. Okay. So what did they say over here? In the required, what did they say? Calculate the business cycle of paw control and comment on the performance of each subsection of calculation included in line with the additional information. Okay, so for each subsection we need to comment. Okay, so commentary. Okay, so basically commentary, what we would say, paw patrol inventory days is higher compared to the industry. Okay, so it's quite higher than compared to the industry. So this is having an adverse effect on the this is having an adverse effect on what you call it. What was, let me just see the question. Okay, that's actually a good question from, yeah, there's a valid point. So the question is, should you ignore income tax and VAT? So I forgot about that actually. So yes, you ignore income tax. Income tax doesn't impact on this, but VAT plays a role. So VAT will play a role in debtors and in creditors. Okay, so VAT will play a role in debtors and creditors. So including it in the debtors balance is VAT. So we actually have to remove VAT. Including the creditors balance is VAT. So we're going to have to remove VAT. Or alternatively, you can add VAT to the other side, but just generally better to remove VAT. So actually a good question. I forgot about that. So for included in the 350 is VAT. So we don't want VAT over there. So I'm going to say multiplied by 100 divided by 115. So now VAT will be removed. For debtors days, included in debtors will be VAT. So I don't want VAT over there. So I will remove it. Multiplied by 100 divided by 115. So how do you know where is VAT included? You must think about the, you need to think about accounting. You need to think about accounting principles. Yeah, so you can let me know, then I'll explain to you the accounting principles. Okay. So let's have a look what is happening over here. So Paw Patrol's inventory days is higher compared to the industry. So this is having an adverse effect on the business cycle. Okay, so I have an adverse effect on the business cycle. So the question would be, how do you reduce it? Okay, so you would have to find out how can you reduce it. So they say all raw materials are purchased on a just-in-time basis. The inventory in the statement of financial position consists of finished goods only. So basically what the company would have to do is to reduce the amount of finished goods on hand and limit it. Yeah, so basically one way they can do is to reduce the number of finished goods on hand. So they're telling you inventory is only made up of finished goods. So the fact that the inventory days is higher, it means they have too much finished goods in store. So what they should do, they should reduce the number of finished goods. They're not giving us enough detail to understand why there is so much finished goods. So one possible reason is the following. So for example, let's use a real world example, right? So take Woolworths, Clothing, Truworths, Fushini. They would have bought stock, they would have bought inventory. So let's say December 2019, right? So I'm just making up stuff. So in November, let's say they bought stock for December, January, February, right? Or let's say in December, they bought for January, February, March, April. Let's just say they bought for 4 months. So in December 2019, what happened in March 2020? In March 2020, we went into full lockdown for how long? 2-3 weeks. And clothing companies were shut down, right? They had to close. So in that case, it makes sense that the inventory days is high because they didn't anticipate that they would be shut down. So they bought inventory for what they would usually buy for, but now because they were closed, they were unable to sell. So that would be a fairly valid reason for inventory days to be high. But if they budgeted for inventory to sell 100 units and they bought for 100 units, for example, but they only sold 80, that would mean that what's the reason? So that's generally going to be a negative impact, because what is the reason that they never reached 100? Were they too optimistic? What's the reason that they didn't actually make the 100 sales? It's either that they were over optimistic or they they're not great at forecasting, or they their products or their pricing wasn't right, and so forth. So we don't know what is the reason for their inventory to be high. So the inventory days to be high. Another reason would be management just tends, some companies wants to have a lot of inventory on hand. So for example, let's say, that's not necessarily true for Coca-Cola, but let's just say Coca-Cola, they need to supply Pick and Pay and all the stores, all the retail stores with Coca-Cola, with Coke, right? So let's say in December, they shut down for the holiday period. So when they open up in Jan, they need to start making sales again, and then you will need to be able to supply their customers. So what they would do, they would make sure they have enough inventory on hand before they close for the holiday period, so that when they come back, they have to sell immediately. Because remember, doesn't they make Coke in a day? So so that is what companies would do if they do shut down. Obviously, Coca-Cola don't shut down, but I'm just giving an example for us to understand. So there's different reasons why inventory could be on a high balance. So we don't know what the reason is, but basically, given the fact that we don't know what the reason is, we just use a standard understanding that if inventory days is high, it is not a good thing, because you're having too much cash tied up in inventory, and inventory is illiquid. Okay, it takes long to actually convert into cash. So that's all that I can say. If there was an actual reasoning, then you could have used the reasoning to explain. Okay, so just take note of that. Then you can see debtors days is actually 59 days. So debtors days is within the credit policy. Okay, the credit policy of 60 days, and in line with the industry. Okay, so we're not going to comment on the 70 days, because I just made up the 70 days based on what I used the formula, because they told us the industry between 45 and 60. So you can see debtors days is within the credit policy of 60 days, our credit policy, as well as in line with the industry, which is between 45 and 60. Okay, so and also remember, our credit sales increased from 55 to 65, I think. So it didn't have an adverse effect, at least. Okay, so that's fine. If it had an adverse effect, we could have made mention that the perhaps the increase in credit sales from 55% to 60% of turnover, or 65% of turnover, could have caused that the debtors days increase, because there's less high quality customers. But here it's within 60 days, so there's no need to complain. It's within our credit policy, so there's no need to complain. So that means increasing the amount of credit sales related to turnover from 55% to 65% did not cause a problem. Okay, then you can see creditors days. Creditors days is higher than the policy, of 60 days. It is also higher than the industry of 60 days. Let me just see what was our policy again. So ours is between 45 and 60 days. Okay, so that's fine. This increase has a benefit for the company's business cycle. Okay, So remember, the longer the credit days, the better, because the less finance you need elsewhere. However, it may impact creditor relations. Okay, so that's important to take note. So the last thing we can say, overall, the business cycle is longer than that of the industry, okay, mainly due to high inventory days, which has been partially offset. So which have been partially offset, offset is the right word, offset by creditors' days. Okay, so you can see creditors' days. So you can see that, so I don't want to comment on debtors' days, okay, because we don't, I made up debtors' days, which is probably right, because they're telling us that business cycle is 100. They told us creditors' days is 60. They told us inventory days is 90. So it can only mean that debtors' days is 70. Can't mean anything else, okay, but I didn't comment on that. But basically, ours is high because of a high inventory days, but it was offset by our higher creditors' days. So that is why it's not as bad. It's only 7 days higher, but 7 days is still a lot. Okay, so basically that is what I would comment on. I don't know if there's a solution and then you can compare to the actual solution, but that's basically what I would mention. So because there's no actual scenario, like there's no specific issues relating to within the scenario, it's a little bit more generic. So these are basically generic, but generic with relative to the scenario. When I say relative to the scenario, I didn't just talk about textbook things. I use the company's names and all of those type of stuff. But in a more challenging question, these will only draw you half a mark each, right? And then you'd have to give the reason relative to the actual scenario. But that there's no real reason that we can pick up from the scenario. So for me, this is kind of the best bet. Okay. So that's all that I wanted to cover. Is there any questions that you may have from your side? Yeah.
I just wanted to know, do we always have to take that into account when doing a question like that?
No. Only like in this question, they specifically mentioned regarding that. So then you do, but in the real world, yes. In the exam, no. Like I said, I even forgot about it because it's not something that usually comes up. This was an assignment, so obviously they make it a little bit more challenging because you have over enough time to work through it, and they know people work together, so they make it a little bit more challenging. So that is why they most likely added the VAT aspect. It's not to say that they won't add it in the exam, but they hardly don't because they're not interested in this whole VAT aspect. They're more interested in the rest of financial management.
I think your data stage is also your figure for your check your data days, the trade receivables figure. I think you forgot the 8.
I'm gonna check now. You see.
Well, the trade receivables was 1 million and 48,000.
Quickly. So my trade debtors. Okay, so you're saying, yeah, what is it?
Yeah, you forgot the 8.
Way.
In your trade receivables amount. You've got.
Oh, I have one. I see what you're saying. I have 104 instead of 104.8. Okay. HSC 1048. Okay, yeah, so it's still okay. Any other difference? I just double check that I put the right numbers in. Okay, thanks for that. Any other questions, Dane?
I still actually get a different amount there. Can you just go back to the debtors days?
Okay.
Sum. Oh, no, it's because of the VAT. Okay. Yeah, you took the VAT out. I didn't take VAT.
Oh, what you call it, yeah. I also didn't take out Pungani, reminded me. Thanks, Pungani. Pungani, any other questions? Sergio, Delita, certainly.
I'm all good.
Okay. Pungani, your side.
Nothing my side.
Okay.
Nothing also on my side.
Okay. So, Pungani, did you guys get the solution to this assignment?
Can you please come again?
Yeah. Do you perhaps have the solution to this assignment?
Yes, they gave us solution.
You just send it to me, please, if you don't mind.
Sorry?
Can you send it to me?
Okay, I will do it.
Yeah, tomorrow, any other day is fine. Cool. Thank you very much, guys.
Okay.
So tomorrow we're going to do. I'm just gonna see. I was looking through it. So tomorrow, what is tomorrow? Friday. So if you have a look at the required. So we did part A, we did part B. Okay, not going to worry with part D. I'll come back to part C when we do capital budgeting. Okay, so I'm not going to do that now. So we did part 2. So now it's only question 3. Question 3 is a 50 marker. Let's see. Okay, so we're going to do this for financial analysis tomorrow. Profitability, liquidity, solvency, investor. So you can see the little marks, only up to 10 marks for calculation and 11 marks is for discussion. Okay, remember, I don't know how strict UNISA is, but on a CTA level, most likely they will be very strict because from a cycle level, here you have 21 marks. So what some people used to do, they only do the calculation and then they don't do the commentary. So CYCA's rule is, if you only do calculation without commentary, even if this is 100%, they give you 0. They only mark your calculation if you provide commentary. So I don't know how strict UNISA is on it. So I'm pretty sure on the CTA level they'll be strict because they need to train you for the ITC exam. So just take note, even if you get 100% for this, if you don't answer commentary, you run the risk of getting 0 for your financial analysis. So we're going to do that tomorrow. What is this one? Oh, this is another working capital type question, but a budgeting, more on a budgeting. Okay, so I'll let you do this for homework, and then you can submit this to me, and then I'll have a look at it. Okay, so you can do that. So question 3, part B is for you guys to do. I'll give you about 1.5 weeks to do it, but we will do part A tomorrow. Okay. Okay, guys, so I will see you tomorrow. Bye-bye.